Welcome back. You're with us on Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studios. Back to talking to Gurmeet, and we're going to be focusing on some individual stocks now. Gurmeet, I want to start first with banks because of the obvious sort of trade that may play out. Banks are anyway oversold, and now that you have this trigger, if it becomes easier for them to mobilize deposits, then I don't know if that starts some sort of short covering move or maybe some real money flowing back in. Your thoughts, and would you look at any PSUs or would you stick to the larger private names?
So yes, I think it could be may not be from a huge long-term impact perspective, but sentiment positive definitely. Also, as you rightly said, banks clearly are oversold. Right from the Adani news now to trouble in US banks, I think that's largely because of the over-ownership. FIs have almost more than 50% ownership is in banks. So I think some of the banks should make a comeback. HDFC, I think the NCLT has approved the merger. And I think that the big overhang goes. I think the rest of the formalities should happen over the next few weeks, perhaps maybe a couple of months. And it will pave the way for inclusion also in the MSCI index. So that could lead to some, near-term positive for the bank. ICICI also, despite one of the best ever Q3s, has been under pressure. Most of the good private sector banks are down 15% plus from the peaks. I think the credit demand is still reasonable. Deposit growth still in double digit. We'll get a boost. Both credit, as Prashant made that point. So I think banks look good. Some of the tier 2 banks like Federal, IDFC, which are actually working on a granular liability base, should be positively impacted.
Okay, another specific name which is there was this some action expected is Sundaram Clayton. You were telling us earlier, Gurmeet, right? Do explain.
So basically, they are demerging, Prashant, their auto business and the holding company business, and trying to. There's a lot of cash on the balance sheet. So for one every equity share, you get about 116 preference share. TVS Group is almost 50% in that, and post the preference shares getting listed, then the holding companies get amalgamated. With it, and then there is a demerger of the casting business and the investment company business. So it's more like it's done pretty well. TVS Group is good on governance. Valuations currently even at this price is 13-14 times, pretty reasonable. But more like a special situation. I would not recommend retail investors to really look at it because it's going to be a little slightly long drawn with preference shares being issued, amalgamation, etc. Can be a little overwhelming, but that's something we are tracking. We are tracking as a asset manager.
Just for perspective, Sundaram Clayton market cap is close to around 9,700 odd crores. The cash they have on their books is close to 2,000 crores, and the value of investments that they have in TVS in particular is well over 12,000 odd crores. So case for that valuation discount or holding company discount to narrow. At the same time, they raised a fair amount of money by selling stake in Suprajit Engineering all of last year. So they had about 4% stake.
Unlocking
value.
All right, that's Sundaram Clayton for you. Let's get one more view, an important one on the debt mutual funds issue. Deepak Shenoy of Capital Mind watches all things, especially things like this very carefully and has a wide-ranging perspective. Deepak, good to have you with us here. We've been discussing the changes, of course, from when we started this morning. But the one question which remains is, what are the implications of this now? From the 1st of April, of course, they become extremely unattractive as a category, debt mutual funds. So where will this money go, which was going into these schemes?
That's a good question. In fact, I think one of the problems right now is it's kind of hit us all of a sudden. But in general, I would say what is happening right now is that you are getting a deferral of the coupons. So if you own a bond or a fixed deposit directly, even when you get the interest, you have to pay the tax on that interest, regardless of whether you use that money or not. In a mutual fund, you can choose to defer it. But earlier, as in right now, whatever mutual funds you buy, you also get the benefit of indexation when you hold on to the fund for more than 3 years, which reduces your effective tax rate to a very little, because if your inflation is 5% and you're getting about 8% on a bond, you're paying a lower tax rate of 20% only on the difference between inflation and the return you've made. So if you've got 8 and 5, you're paying only 3. So it was a relatively more more favorable tax scheme for mutual funds specifically. I think what they've done is they've decided that this is not the intention, or because they removed the MLD taxation, which was also a similar concept where people held for 3 years, got debt returns, got relatively low taxes, and were still able to get high returns if they held for 3 years. So they've cut the loophole for debt mutual funds as well. I think this is not very good for the debt markets in particular, as they were starting to develop. It's more institutional market. I think people in the end will look at it as, oh, it is equal to FD, but I don't have to pay incremental taxation on coupons. It's actually still a good product for cash flow. So you can actually say, listen, I'll put my money into a debt fund and take out only the interest component every year. It will be far more favorable, even with this new rule, compared to an FD. So if I take out only the interest portion of 7% or something like that, which I earn, I'll actually still make a better return than post-tax return than a fixed deposit. So yes, it's a little disappointing for the mutual fund industry, but I think overall favorable.
That's an interesting one, Deepak, that you mentioned. You're saying that if someone's withdrawing interest only on a quarterly basis, then the returns are still better than an FD?
Yes, because of the structure of the way your units are calculated. So what happens is, if I put, let's say 1 lakh rupees into a mutual fund, and in a year I earn 8,000 rupees. When I take out money, instead of taking it out as a dividend fund, I actually sell 8,000 rupees worth of units to take out the interest. The actual tax on that 8,000 rupees is considered to be bought at 10 rupees and sold at I think 10.07. So your effective gain is only 500 rupees in the first year. Of course, the gain keeps increasing every year, but that also means you'll be in more favorable income tax regimes later, because the minimums will keep going up, so that you're actually deferring your tax to a much later stage when you do something like this. Whereas in an FD, you'll pay tax on the entire 8,000 rupees as income, so you'll pay a much higher tax rate.
So would this be applicable to target maturity funds? And the reason I ask you is this. I think it was target maturity which retail started understanding as a category, and therefore the mobilization of AUM over there. Gurmeet was with us on the show just a while back, and he was saying target maturity has an AUM of almost 2 lakh crores out of the total 40 lakh crores. So would this help this category? Because it's this category which will very easily move back to FDs. I mean, if it's too complicated to get the taxation benefit here.
The problem with the target maturity funds is that on the target date, you get your money back, and then the entire gain will be taxed as income on that date. Versus if you look at a regular kind of like a short duration or a long duration mutual fund, they continue. So there's no target maturity, but they continue. So the only way that, this would, of course, this will equate this a little bit with FDs, but I still think that given that you're able to defer your coupon taxation till the time that you actually wait for maturity. And at maturity, a lot of the mutual funds will now start to give people an option saying, let me convert this fund into another fund that I have, which is what is happening in one of the target maturity funds in the market. They will allow you to seamlessly transition into another mutual fund, which is a different target maturity date, that way deferring your taxation even further. It is, of course, it will result in some of a shift to FDs, perhaps, but, to be honest, FDs aren't giving people much money in comparison with some of these funds. Nobody has decent enough returns in 5-year FDs. So I think at some point, if these are equal to them, then I will choose the one with the better rate.
Got it. Deepak, thanks very much. Good speaking with you, and we'll touch base again for more nuance on the subject. I just want to say one thing. If you're watching this, and these are big changes which are coming through, before you decide to change anything with your own portfolio, do consult your financial advisor. These are important tax changes which are happening. So while we will continue to highlight and try and get you the best perspective, but for individual decisions, you must speak to a financial advisor before you do anything at this point in time. At 11 o'clock, I just want to make a mention that you will catch more on this with an extensive panel, which we will dive a little deeper into this one. For now, of course, all eyes are on market opening, which is not very far away, 6 or 7 minutes out.
Well, for pre-opening, it's absolutely flat. All the frontline indices have settled flat, but we do have a couple of names which are buzzing around in the pre-open. We have Vedanta, which is up around 2.5%. This on account of the fact that they will consider dividend. IT stocks are doing well this morning on Accenture numbers. The stocks which are not doing too well, understandably, the asset management companies. So HDFC AMC comes up for you, which is down about 2%. All these are pre-open rates. Of course, we will await these actual opening in 5 minutes from now. It's 9:10, so perfect to get in Mitesh's 9:10 call. Mitesh, what are you looking at?
You go with the buy on Aurobindo Pharma. Keep a stop below 479 and 500 is the target.
Okay, got that. Thanks, Mitesh. We'll come back to you once the market opens up. Let's quickly get in a conversation on the read-through from Accenture's numbers and commentary that came in yesterday. Manik Taneja, Executive Director, IT Services at Axis Capital, is with us. Manik, good morning. Good to have you on the show. Different parts to it, right? While the quarterly performance that Accenture delivered was great, there are two things that I think people will think about. One, that they've lowered their full-year guidance. And two, they've also announced layoffs. 19,000 people laid off. So that kind of tells you maybe demand is not as robust as what they had previously thought. How would you interpret this?
Sure. First of all, thank you for having me on the show. So, first of all, on that guidance change, I would say there is some element of demand moderation and some element of lower contribution from acquisitions. So, the earlier guidance of 8 to 11% included about 250 bips of inorganic aid, while the revised guidance essentially includes about 200 bips of inorganic aid.
Yeah. We can hear you. Go on. Yeah, you're saying that that there are two parts to that guidance lowering,
yes,
including, of course, some delays in the deals. Yeah.
And the other thing that I would say is that managed services / outsourcing, which is the real comparable for Indian IT, over there has been no change in terms of the growth outlook. Still expect that business to grow in double digits, as per Accenture commentary yesterday. While the consulting piece is the one which is seeing a hit. So you would see that last 3 quarters in a row, managed services / outsourcing has outgrown consulting. And even from a full year FY23 outlook, earlier the expectation was that consulting would grow in mid to high single digit. Now the expectation is that consulting grows only in mid single digit. So that's from a guidance point. The second question that you had was with regards to the headcount rationalization that Accenture plans to do over the next 18 months. I would say this is par for the course, and one will not be surprised to see similar optimization actions being undertaken by the industry. To just put things in context, in FY22, the top 6 or the Twitch companies added almost 3.2 lakh employees, which was higher than the cumulative employee addition that the sector did between
Manik, I'm so sorry to interrupt because we're running into market opening. Just a quick 30 seconds. Is there any read-through for listed Indian IT companies? Is there any reason to get worried and think that maybe there could be a bit of a top-line slowdown here? Any read-through for Indian listed IT?
Certainly what's been happening over the last couple of weeks will drag the sentiment in terms of even customer decision-making. But I would say the current results will not be a negative read-through for Indian companies. And given the weakness in these names, one will expect some positive reaction to the results.
Not just the current results, I wanted to know if you heard from Accenture on the conference call about the global banking turmoil. What do you think they were talking about with regards to this? And secondly, Indian IT companies, have you had any conversations with them as this crisis was unfolding? What are their thoughts from a 2, 3, 4 quarter perspective?
No, certainly, as you said, with whatever news flow that's emerging from the banking industry, it does potentially increase the risk of some caution, some sort of a standstill in terms of customer decision making, and which always tends to essentially work to the disadvantage of Indian IT. As such, our channel checks all through the last few months essentially seem to suggest that businesses globally are preparing for cost optimization and doing more work out of India, and which should work to the advantage of Indian IT as such.
Manik, thank you very much. Good speaking with you. Appreciate you joining in with that perspective. There's about 30 seconds to go, a little more than that for market opening. So we'll stick with, of course, as prices as they start to come through. I mean, there are 3 or 4 clear categories of stocks where I think IT, of course, is one, as Manik just pointed out at the back of the Accenture numbers. There are asset management companies which get hit because of, I guess, debt schemes will see far lesser inflows post the 1st of April. Banks, I mean, we'll need to see what the numbers are, but will this result in more deposits for banks? So banks is on the positive side. And insurance, I mean, there is no relief for insurance as we were putting out that the industry is expecting. So that's the other category to watch out for. It's a positive start. 17,077 is where the index is opening up at. And you've got, okay, absolutely flat, 17,072. So neither here nor there, as the sort of SGX was indicating off earlier and the pre-open after that. So very, very flat kind of levels. Bank Nifty is down a little bit more. It's down 1/3%. Banks sold off more than the Nifty yesterday, full 1% cut. It's blinking red and green now. These are very early kind of rates which are starting to come through. But I just want to quickly take a look at the AMC names. HDFC AMC should come up on your screen. It's down 4%. I think we should look at Nippon. We should, yeah, UTI AMC is another one. It's down about 2% or so. Nippon India Life is that's a life insurer, which is down about 1.25% as well. Banks is the other one. Maybe just look at ICICI Bank and the likes. As I said, the exact implication will have to be worked out, but they are flat starts. ICICI Bank is absolutely flat, and the largest PSU bank, SBI, is also absolutely flat, no change at all. Let's look at life insurers, right? ICICI Pru Life is down 2%. As I said, if the industry was expecting some relief on that 5 lakh sort of limit and some sort of relaxation there, this is also, of course, post 1st of April. There's nothing. HDFC Life is down about 2% or so. Nippon, of course, we already put out. IT services is the other pack which we can look at. The index itself is up 1.5%. The Nifty IT index is up 1.5%. So one can assume that stocks are up as well. Surabhi.
Looking at the PSU Bank Index, which has started on a very flat note, actually, not too much of movement. And if you, I was looking at an immediate, flow through on some of these PSU names, but it's not quite there. Beginning to build now. UCO Bank, Bank of Baroda, some of these names, IOB. A little bit of green is now beginning to emerge in these stocks. Remember, it's a conversation about if this money is going to start moving back to FDs, then do these banks benefit? Anyway, flat trades coming in over there. The index itself continues to be absolutely flat, just about 9 points higher. The leg that's working on the upside is IT. Your Tech Mahindra up 1.5%, HCL Tech, Infosys, TCS, Wipro, all of IT is seeing a big rally. Of course, US IT stocks did well. And then we had the flow through from Accenture. ITC is up and about. Those are the pull factors on the upside. On the downside, it is the life insurers, SBI Life, HDFC Life. On the downside, HDFC is also slightly lower. Reliance, again, continues to be a pressure point. So even Steven, but now Mangalam, it's beginning to pick up a little bit of positive bias.
It is picking up a little bit of positive bias. Apart from the sectors that you guys have been talking about, which are not doing well, the AMCs and some of the life insurance names, we have most of the sectors which are doing well. In the mid-cap end of things as well, we have 2 stocks advancing for every stock which is falling. We spoke about the IT stocks doing well in the frontline end of things. The mid-cap IT usually has a higher delta. So a lot of these mid-cap IT names are picking pace as well. As we speak, among the top 4 gainers in the F&O space, of the top 5 belong to the mid-cap IT space, be it Persistent Systems, Birlasoft, LTI, Mindtree. Then you have, individual stock-specific news action as well. Hindustan Aeronautics and BEL, of course, gaining on the back of orders coming in from the Defense Ministry. We have Vedanta, where they will consider an interim dividend. That stock is higher. Campus Activewear, that large trade has taken place, 8.1% equity, which we understand was sold by TPG, is the stock on our radar. It opened about 5% lower at the price at which the large trade took place. But from there, we have seen a bit of recovery from the lows on account of the fact that maybe the supply pressure has gone away. The other stock which I'm watching out for is Sundaram Clayton as well, which is now down 11%. A name that Gurmeet also spoke about, a special situation out there where they will be issuing some preferential shares. So it is adjusting for that. So that stock is down about 11%. But by and large, it has been a positive start at the mid-cap end of things. The index was mildly in the red as we opened and now continues to move into the green. 2 stocks advancing. All right,
Mangalam, so it's a decent kind of picture, right? 20-point change, 17,097 is where we're at. The financial intermediaries, both on asset management and life insurance, are the ones which are taking the knock. I'm just looking at the top volume traded moves. HDFC Life, HDFC AMC, ICICI Pru, all down 2%. For of course the reasons, of course, we've been discussing since the morning. AB Capital is down about 2.25% as well. SBI Life is down 1.7%. So more and more are joining. Shriram Financial Services is down about 1.5%. So there is some pressure. M&M Finance is down about 2.25%, unrelated with regards to, of course, the changes which we're talking about. But financials are the pocket where we are seeing some pressure starting to intensify. The Adani Group stocks, I want to make a quick mention. Green is up 5%, transmission is up 5%, total gas is up 5% as well. Those three names are locked up at the daily limits at this point in time. Tech stocks we already mentioned, so won't repeat it. Maybe we'll come back with more names in a bit from now. Soba is, after 2 days of almost a 15% knock, Soba is starting to see some signs of life. But let's see if it's short-lived or there's something here. 1.5 higher on Soba at this point. Our market master of the day is Harsha Upadhyay, Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thank you very much for your time. I'm not sure if you've spoken with your debt counterpart this morning, Harsha, and how they are feeling. If you have, and any feedback as a fund house.
Good morning, Prashant. Clearly, what has come out last night is a negative surprise for debt mutual funds. But even within debt mutual funds, there are two categories, I would say. Those who come in for parking their investments in the short term, and those who really look for indexation benefits. And those set of investors obviously will be disappointed because it's not going to be available post end of this financial year. For the rest of the debt investors, there is no change in terms of the taxation because they were even earlier looking at exiting in the short term. For them, there is no impact. But when you look at the overall industry, there is about 15% of total industry AUM, which probably would be based on the indexation benefits. And that category is unlikely to grow from here on. Rest of the categories, there is no impact. And probably the rest of the categories could get some of the flows that will probably move from this indexation category into other categories.
Right. Harsha, how are you generally feeling about the market right now? We've been in a bit of a range, and as we speak, the opening high has actually been sold into the Nifty at the low point of trade. It is dragged low by the banking stocks. We have some sell-off coming in from the IT pack as well, which is now off highs. And just looking at Reliance, that heavyweight too has moved to the low point of trade, so that's weighing down on the index. What are your general thoughts on the market right now, Harsha?
Mangala, we continue to believe that while valuation risk has reduced in the markets, there are macroeconomic challenges that one will have to keep looking at. So to that extent, we may still remain in a range. There are no real triggers for a great rally from these levels at this point of time. So only when you see some visibility in terms of improving earnings trajectory or some of the macroeconomic headwinds kind of subsiding, you will probably see a rally. But until then, we believe it's going to be a range-bound market.
So then, what are you buying in this range-bound period, Harsha? Morning, Surabhi here. I think for investors, it's getting a little difficult because patience has been tested all of 2022 and 23. So far, we are down. So I'm sure people are wondering really, how to look at things.
True, Surabhi, but these are the periods where you have to keep doing what you're supposed to do in terms of investment discipline. And generally, after periods of consolidation or after periods of a negative drawdown, you usually see great returns coming from equities. So one can't say when it's going to change, but definitely these are not the levels or the after the time correction of about 1.5 years in the same range. These are not the periods where you should lose your patience and start to do something else. I think clearly what you believe in terms of fundamentals, where you believe there is going to be some steadiness in earnings is where you need to keep picking your choices. Clearly, our focus has been domestic businesses, where we believe both growth as well as in terms of demand trends should be clearly in favor of these companies. And that's the pocket that we are focusing on.
And what would those pockets be? Where are you seeing some value?
Banking, auto, cement, industrials. These are some of the pockets where we have been overweight for quite some time and continue to focus on these. Clearly, this is not a market where you will see a uniform rally across the sector, but definitely within these 4-5 sectors, definitely you will get good choices.
Okay, you'll get good choices. Would you reckon, Harsha, that in consumer names, right, consumer discretionary names, there were lots of these fancy themes. Footwear suddenly became the hot sector, and many others as well. I'm just mentioning footwear because of campus and the block, etc., which has happened. Have valuations come to more reasonable, attractive levels, or you think there is still some ways to go? What's your sense?
In our opinion, it's still expensive, Prashant. Clearly, these were the pockets which performed much better than the rest of the market for a good 3-4 years until maybe last couple of quarters or so. Since then, we have seen a kind of slowdown in terms of demand, which still continues. And also we have seen inflation eating into profitability margins. So at this point of time, not only valuations are expensive, but I think at least in the immediate term, the earnings growth trajectory is also lower than what people were anticipating, and also worse than what the long-term trends have been for this segment. So to that extent, we don't see this pocket outperforming in the immediate term. But yes, many of these companies have very good strength in terms of brand, in terms of distribution network, in terms of how they've survived various cycles. So post this downturn, definitely there will be a few good picks that you can buy into. So this is something that we will have to keep monitoring for the next couple of quarters and see where that value emerges.
Harsha, thoughts on two areas of the market that have been beaten down quite badly. One is obviously IT services, and the other is this whole new age playground. And we've seen what's happened to the stock prices, right? Major value destruction from the listing highs. Are you looking at either?
We do have some positions in IT services segment where we believe valuations have corrected quite nicely over the last 15-18 months. But yes, there are still some concerns on the business side, whether the momentum will remain the same as what the market is expecting, etc. And given the fact that interest rate hikes are still continuing and we don't see any reversal anytime soon, there is going to be definitely some impact on the global growth as we go ahead. And if that were to come by, there will be some slowdown in terms of the business momentum. So whether everything has been discounted or not is a question. But from peak valuation levels, most of these have corrected to reasonable valuation levels. So we do have some positions in IT services. But as far as some of the new age businesses are concerned, we are still not so comfortable in terms of the valuations. And we have largely been avoiding these names in our portfolios.
Harsha, one of the big trends that emerged all of last couple of years was the K-shaped growth that everyone's talking about, strong demand at the higher end of the luxury segment and, decaying demand at the lower end of the consumer spectrum. How do you play that, if at all you do, and what stocks would you back in the consumer space then, if at all?
We do have positions in auto, for example, which I would consider as a higher end of consumption demand categories, where we believe that as inflation moderates and since some of the new products have evinced good interest from the customers, there is outperformance to be achieved in that particular segment. But as far as some of the other themes in the consumption which are related to rural segment, for example, I think the slowdown still continues, and we may have some more time before we start looking at some of these names aggressively. As I mentioned earlier, I think we would need a little bit more of comfort in terms of valuations to get into some of these names going on.
You said it'll be difficult to make money this year. I mean, would you have any sort of, number to that? Just this year, would we underperform debt? How would we do going forward? I mean, the Nifty year-end target, if at all?
We don't work with any targets, but clearly I think with the correction that we have seen over the past couple of months, valuations have become more reasonable. So to that extent, I think from here on, the market returns could track earnings growth, which is likely to be decent. It may not be as strong as what the market has been expecting, which is around the mid-teens, but it still should be decent. So our belief is once the short-term volatility subsides, you should see markets moving more in line with earnings growth over the next 1 year or 2 years.
All right, Harsha, we'll leave it there. Thank you very much for your time. Appreciate you joining in with that perspective. Thanks indeed. You know, the market's now down firmly. We're down 50 points, by the way, on the index. So just want to take stock of some stocks and how things are moving. I mean, actually, it's a pretty steep slide. The high was made exactly at 9:19, 4 minutes after open. It was 17. The high was 17,109. And we've come off almost 90 points from the highs of the day. From between 9:19 and where we are now at 9:30, we've come off these 90 points. So it's been a steep one. Now, the Bank Nifty should also come up on your screen. I think a similar kind of picture, but less steep on the Bank Nifty. The high was made at 39,669, and we're at about 39,481 on the Bank Nifty. Just a few names. By the way, market breadth, which was positive when we started, is now completely flatlined. 1:1 advances to decline ratio. And if you can have these names up, Campus is down 6%. So 348, 349 still there. I mean, started down 5, so it's still there. Bajaj Finance has come up. It was not in the mix earlier, but is down 2%. Bajaj Finance at 57.24. That's a large name, underperformed in 22, and so far this year it's been tough for it. HDFC Life is still there with the 3% knock. Actually, HDFC Life has lost a little bit more. AMC was down 4% when we started. Life is down 3.2. Zomato is down about 1.7% at 52 on large volumes. AMC is still down 4. HDFC AMC. Bajaj FinServ is down 2% as well. So the Bajaj twins are coming under pressure. AU Bank is down a full 3%. These are names which were not there in the morning. ICICI Pru was there. It's still down about 2.5%. JK Tyre saw a very large move yesterday. It's pulling back just 2.5% right now. 164. Biocon has had a pretty tough last fortnight or so. It's down 2% on decent-sized volumes. Right. There is SBI Life, which is down about 3% at about 1,089. Shriram Finance, I mentioned earlier. Bandhan Bank is another one, which is down 1.7%. I must say that on the losing side, there is enough volumes for this time in the day, right? I mean, yesterday, even at 3:30, I was looking at the losers list and declines outnumbered advances, but, you know, it was not backed by volumes. But right out of the gates, within 15 minutes, there's strong volumes across the board. And I could go on with more financial names, not banks, but Bandhan Bank, AB Capital, M&M Finance, Chola Finance, all. Muthoot Finance is down another 1.6%. So lots of financials, our ex-banks, are taking it on the chin.
And we'll have to watch out for the level as well, I guess, Prashant, because, just trying to hold 17,000, let's see what happens. Yesterday we were just around this level, dipped a little bit, and then there was an up move. But the market largely held above the 17,000 mark, at least yesterday. Today we're getting this decisive dip pretty early on in the day. To be fair, Asian markets are also more on the red side than the upside. But nonetheless, this is quite a dip coming through. And again, it's the banks. I mean, there's just no let up in selling pressure, though there's, technically, sentimental positive news this morning, potential positive news. Now that it's helping the banks.
You spoke about the technically sentimental positive news. Well, technically weak news came in from the technicals yesterday, where it broke the 200-day moving average, which was 39,717, and it's now selling off way more. We had less buying in the Nifty bank as against the Nifty as well yesterday. But I'm just looking at a couple of stocks which are doing well this morning, and there are a few of them. Aarti Drugs, all of this week, the stock is up 25%. Wonder what's going on out there. This morning itself, it's up around 6%, and with volumes piling up. In fact, I was just looking at the exchange notices. On 21st March, we had, the exchange asked the company as well what the reason for this volume spurt in the counter is. They said they do not know. It's purely market driven. So that is one stock I'm watching out for. The other one, as things heat up across the country in summers, we are seeing Varun Beverages continue to see some traction as well. The stock is just about 5% away from its 52-week or all-time high. So Varun Beverages, the Pepsi bottler, doing extremely well. Metro Brands is picking up some pace as well. Opened in the red and has now moved higher. And Phoenix Mills is the other one which is doing well too. Indigo is the other one which we're looking at too right now. So let's actually get in, Sonal, back on Indigo. There was an analyst meet. Brokerages have made their notes as well. It's moved from the lows, has now moved back into the green.
It has, because the takeaways were largely positive. In the analyst meet, the company said that yes, they did see a seasonal dip in fourth quarter as far as the yields are concerned, and it is actually lower versus the normal normal yields, and this is despite the fact that occupancies were on the higher side. First quarter, however, they expect to see some recovery in terms of yields as well. So first quarter of FY24 will be a good quarter for the company. They are targeting north of mid-teens growth in FY24 and also plan to double fleet by 2030, something that is happening in the entire industry and the sector as well. They are also targeting strong growth not only from their domestic business but the international business. They are charting new territories in that space as well. Management said that it does not have any clarity on capacity addition outlook by peers, but they are going to add capacity in their own company. Jeffrey says that yes, while lower crude has improved the near-term outlook, they are still underperform on the stock because of the competition concerns and the addition of fleet by other competitors. Macquarie has an outperform rating. They say international expansion will drive the next leg of growth for the company, and FY24 will see momentum sustaining as well. And Citi says current yield trends are fairly healthy, adjusted for the seasonality as well.
Okay, Sonal, thank you very much for the update on Interglobe Aviation. That's a stock in focus today. Well, time now to move to a very interesting conversation. We have a special guest joining in, Mr. Dinesh Khara, Chairman at State Bank of India. Mr. Khara, good morning. Thank you so much for taking out the time and being with us. It's always fantastic to speak with you, and we have so much ground to cover. You know, I thought I'll talk about business growth and momentum, but then there is a bigger pressing issue, a hotter issue, if I can say, that the market is looking at today, and that's the prospects of taxation turning unfavorable for debt mutual funds. And the reason I want to start with this is that this has been a constant cry, I think, from banks, deposit mobilization. In fact, for SBI itself, I mean, while the results were fantastic in the third quarter, your deposit mobilization quarter on quarter was, I think, just under 1% or so. So your thoughts on this? There's chatter that it's actually banks who have lobbied hard to get a level playing field for fixed deposits. Your thoughts, and whether this will actually help banks if indeed we get these amendments in the finance bill today.
Good morning. I would say that, as far as this particular issue relating to the taxation for debt mutual funds, I would say that I think it must have been in line with the government thinking, which they have been having for quite some time. What should be the treatment for the capital gains? So that is something which is one of the guiding factor to my mind for having this kind of a proposition. Otherwise, I think as far as, when it comes to mutual fund versus bank deposit, these are two very different asset allocations. So I think those who want to put in their money into mutual fund, of course, it's with a very different objective they have in mind. So I think as a competing proposition, I don't think so it is competing. They may be overlapping to some extent, but overall, I would say bank deposit are a very different asset class as compared to mutual funds.
But Mr. Khara, just to follow up on that, tax was a huge instrument which led a lot of the retail investors to move away from FDs. Just because post-tax returns on some of these target maturity funds, which is simple to understand, largely investing in AAA securities, that's where the big shift of money was really happening. So you don't think that now there's going to be an advantage for banks if the taxation incentive is taken away?
No, much of it will depend upon that what is the kind of a potential yield from such kind of funds. And if at all there is a taxation also, capital taxation gains where the taxation benefits used to be available in the past, if at all they are withdrawn, what is the net yield? So I think, I think tax is one of the component which people have to be cognizant of. So they will look at the net yield post-tax, both in terms of the debt mutual fund as well as for the bank deposits as well. And to my mind, I think if at all, and also it is also a function of the risk-reward relationship, because the kind of bonds which are there in those debt mutual fund, that will also be one of the guiding factor. So I think taxation is something which one has to live with. So this will be my reaction.
Mr. Khara, good morning. Good to have you with us. Just to press on that point. So, and feel free to correct me, sir. The bank deposits in aggregate are about 215 lakh crores. Debt mutual fund AUM is about 20 lakh crores. Now, assuming that no incremental flows from the 1st of April go into debt mutual funds, assuming say 12-15% growth, what can be the incremental increase in bank deposits according to you? Can it be 1%? Can it be? Will it be less than that? Will it be?
Yeah, no. See, the point is what you mentioned rightly, that 200 trillion plus is the bank deposit and about 20 trillion. Actually, 40 trillion is the total mutual fund size. So from that mutual fund is about 20 trillion. I'm not too sure, but whatever it may be, I don't think so that there are certain set of people who would like to keep their funds into the debt mutual fund, irrespective of the taxation impact also. So I think whether we will have 1% gain or so, it is very difficult to predict. Perhaps maybe we'll have to wait and watch how really it makes a difference as far as the deposit climate is concerned for the banking system. But banking system deposit essentially accrue from the overall growth of the economy. This is how I look at it, and that is one of the major catalysts.
Mr. Khara, any impact on the lending side, sir, because of this? I mean, will this lead to sort of more borrowing from banks rather than from mutual funds?
I don't think so. I don't think so, because those who go for the debt issuance, debt paper issuance, they are the one who participates in the debt capital market. That debt capital market is a very shallow market as of now. Okay. So even if I don't think so, it will have any significant impact in terms of the corporates reaching out or newer corporates coming to us. I think it will have very nominal impact, nothing very significant.
Right. This aside, Mr. Khara, how has business generally been? There's been talk of some moderation in loan growth. Have you seen that as well? And what about net interest margins? As cost of funds increase, do you think there could be some compression in order for that as well?
Well, as far as business growth is concerned, loan book, we expect that this year we should have at least about 16% kind of a growth in the loan book. And as far as deposits are concerned, they are growing at about 10% or so. For the system level as a whole, also, my information is that incremental bank credit has grown by about 15.5 trillion plus, and whereas loan book deposits have grown by about 14 trillion in the current year. So I think overall, I would say that there is a decent traction both in terms of deposit as well as loan. And what we have also started observing is that of late the capacity utilization has started improving, so which has led to availment of the working capital loans as well. So I think this augurs very well for the growth as far as the loan book is concerned. And apart from that, I think in the current year also, of course, that shows up with a lag. Last year, we had seen as that there was about 20 trillion worth of fresh investment commitment as per the project today estimates. And a significant portion of that had come in from the private sector. This year, till the month of, in 9 months' time, it is about 21 trillion. But this commitment, of course, shows up with a lag. So normally we have seen that it is actually an early indicator for the investment behavior.
Mr. Khara, your term ends in October this year. Wanted to know if there is any unfinished dream, unfinished business that you have, especially with regards to another SBI unit listing. Could it be, general insurance or any other business vertical? Do you think you would do that before your term ends in October?
See, the point is that irrespective of my term, these are the assets which bank takes a call at the material and opportune time. So we will be taking appropriate call as and when the opportunity arises. I think as of now, the markets are quite choppy. So it may not be a good time for us to list our crown jewels like that.
Okay. Mr. Khara, fair enough. I just want to go back to the loan growth point, and if you could give us some more granular color on how segments are behaving. Retail did very well for you, for instance, in the third quarter. But what we are picking up from latest commentary from corporates, at least on the retail side, for instance, car manufacturers or even housing, that there is some hesitation. I'm not saying a deferral, but some hesitation, some rethinking in terms of large ticket item purchases. I don't know if that's already beginning to show up. What is the outlook? I missed a number, the total loan growth outlook that SBI has for FY24. And within that, perhaps a view on the segment, corporate and retail.
No, we are hoping that in the next year also we should be in a position to have a loan growth of somewhere around 14% or so. And when we look at the kind of industries where this kind of a growth is what we have seen in the current year, of course, we have seen it's actually quite broad-based growth which we have seen in the current year. It is in the corporate book, it is into the retail, it is into the SME book, it is also into the agricultural sector. So it is actually all pervasive. So that is something which we have seen in the current year. And I think the kind of climate which is there in terms of, the focus on manufacturing, focus on exports, that actually augurs well in terms of supporting all these core sectors of the industry. Infrastructure remains the one of the major plank for growth of all the economies. So I would say that infrastructure-related core sector, then the renewable energy, which is one of the major focus area, EVs, batteries. So I think practically, apart from the conventional industries, we are seeing growth all across. So I think that's how we expect the situation is going to continue in the coming year too.
And no slowdown in retail also.
Yeah. I think retail, we have seen that till the month of January or so, we had seen, as far as our mortgage loans are concerned, we had seen an increase in sanctions to the extent of about 24-25%. So, of course, the growth comes after taking care of the repayments. But I would say that this trend is very, very healthy trend, which we have seen.
All right, Mr. Khara, it's always such a pleasure speaking with you. Thank you very much for your time here on CNBC-TV18. Thanks indeed for being here. Well, that's the chairman at the country's largest bank explaining to us the implications of the latest changes on the debt side, debt mutual fund side, but also, business growth trajectory for the bank itself, which stays pretty solid. We'll take a quick break here. We have Pramod Amte of Incred Equities who will join in to put the focus on the latest market trends. They have a strategy note out, so we pick up on that. And later, Samir Dheer of Sonata Software will join in to talk about their acquisition of Texas-based IT services firm Quant Systems. Stay tuned.